Hi, and welcome back to another accounting session. Today we will be looking at the topic of takeovers, and in an earlier video we introduced you to the topic of takeovers, and we stated that a partnership can incorporate a company and then sell their partnership to that company. We also spoke about the fact that companies can also take over other companies as well, and we looked at the accounting entries when it came to partnerships being taken over by a company, and we stated that you will follow the accounting entries for dissolving a partnership when looking at the takeover of a partnership by a company. So what we will be looking at in this session is this example question, and we will be demonstrating for you how to go about accounting for the takeover of a partnership. So this question we're looking at is called Pam, Lam and Tien. So Pam, Lam and Tien have been in partnership for many years, sharing profits 4 to 3 to 3 respectively. Their summarized balance sheet at the 31st of August 2005 is as follows. So they have fixed assets of premises, equipment, motor vehicles of $160,000, $93,400, and $65,800 respectively. And current assets, stock or inventory of $52,000, debtors or accounts receivable of $24,200, and they have their creditors or accounts payable $16,800 and a bank overdraft of $11,000. They are also financed by their capital accounts for Pam, Lam and Tien, $128,000, $120,000 and $72,000 respectively. And their current accounts, Pam has a credit balance on her current account of $6,810, Lam a credit balance of $5,100, and Tien a debit balance of $14,310. There's also a long-term liability or non-current liability, which is a loan from Pam of $50,000. The question goes on to state that Apex Limited was incorporated to take over the partnership. So there's a possibility that the partners created a company to enjoy the benefits of such business structure. So it's a possibility that they created this company called Apex Limited, and they're going to use this company to take over the firm, the partnership firm. Now, the company has an authorized share capital of $150,000 of ordinary shares of $5 each. So this $5 is the par value for the ordinary shares. And remember, we stated that the authorized share capital is the amount stated in the articles of incorporation, the maximum amount of shares that they are allowed to issue, which is 150,000 ordinary shares, and then 50,000 5% preference shares of $1 each. And again, the $1 is the par value for the 50,000 preference shares. The purchase consideration was agreed at $360,000. And as stated previously, we said that the purchase consideration is the price that the company is willing to pay the partnership for their business. And we stated as well that the purchase consideration, what can happen is that, let's say Apex Limited can use cash, can opt to pay cash, they can opt to issue shares, also debentures or loan notes, in order to settle or pay for the business. So in this particular example, the purchase consideration was agreed at $360,000 to be settled by the issue of 62,000 ordinary shares at the par value. So they are going to use 62,000 ordinary shares at $5 each and 30,000 5% preference shares, but they have not told us what the price of the issue price of these preference shares. But we know for sure that the par for a preference share is $1. So there's a possibility that these shares are being issued above par, which will be at a premium. But whatever they're being issued at, the fact remains that these 62,000 ordinary shares, the value of these 62,000 ordinary shares and the value of the preference shares along with the premium will bring us to the $360,000 as the purchase price for this firm. Continue our question. Now, the company agreed to pay off the partnership's creditors. So this is the company called Apex Limited. They are going to take on the burden of paying off the creditors. So because they are going to do that, what we need to do is to also realize our creditors when we are looking at closing the partnership books. So the company agreed to pay off the partnership creditors and Tien took home one of the vehicles that had a book value of $15,000 at a value of $12,500. So remember, we stated that when a partner takes an asset, you have to record in the partner's capital account the asset at the value the partner is taking it at, which is $12,500. Now the remaining assets, excluding the debtors, were taken over at the following values. So Apex Limited took over premises at $240,000, equipment at $17,400, vehicles $50,200, and stock $41,600. The debtors realized $23,900, and when they state here that they realized $22,900, they mean that they collected this amount from their credit customers. And dissolution costs, and remember we stated that there's usually a cost associated with dissolving a business. So the dissolution costs for this partnership were settled by the partnership at $2,800. The ordinary shares were distributed via the profit sharing arrangement of the partners, and this was stated in the earlier video that when the ordinary shares are issued, you have to use the profit sharing ratio by the partners to distribute the value of those shares among the partners, while the preference shares would be distributed to the partners according to their last agreed capital balances before the takeover. And any premium on the preference shares will also be distributed using their last agreed capital balances. If there's a premium on the ordinary shares, that would be distributed using the profit sharing ratio. Finally, Tien was declared bankrupt and was unable to settle the deficiency on his capital account. The other partners paid in or received amounts to close the partnership books. So in other words, the other partners had to either pay money into the bank account or they received money from the bank account in order to bring the books to a closure. And remember, we stated that when a partner is declared bankrupt or insolvent and cannot pay off their debt, we apply the Garner versus Murray rule of 1904 to take care of this debt that the partner cannot pay off. So the requirements for this question, what we need to do, we will be preparing the following accounts to reflect the closure of the business. In other words, we'll be dissolving the business. So once you would have done dissolution of partnerships, we will be following the same procedure for dissolutions, but we will be doing it with a slight modification because this is a takeover. So we are going to be doing the realization account, the capital accounts, and the bank account. Now, the balance and also the balance sheet of Apex Limited immediately after the takeover. So now let's look at the first account that we're going to look at is the realization account, and we are going to follow our accounting entries for the dissolution of partnerships in order to look at our realization account. So this is our question here, our solution, Pam, Lam, and Tien. And this is our realization account. The left side, remember, is the debit side, and this is the credit side. And the accounting entries state for dissolution that one of the first thing we need to do is to transfer the book values of all the assets to the realization account. So these are the ones that you will not be that you have to transfer all the book values of all the assets to the realization account. So let's transfer those book values. Let's look back at our question here. So we have to transfer the book value for premises, $160,000, equipment, $93,400, motor vehicles, $65,800, and stock, $52,000. We will not be transferring the debtors because we will be collecting money from these debtors. Although we will not collect all the money, we will collect some of the money from the debtors. So we will not transfer the value of our debtors into the realization account. So let's go. So the first one we have is premises, $160,000. So to do that, to do the transfer, you debit the realization account. So this is what we're doing, debiting the realization account, and the credit entry will go to the asset account. So in other words, realization is debited with 160, and the premises account will be credited with 160 to close that account off the books of the business. The next one is equipment. So we're going to debit realization for $93,400 and credit equipment for the same amount to close that account as well. We're going to debit motor vehicles for $65,800 and credit the motor vehicle account to close that off. Debit stock or inventory, I want to call it that, and credit the inventory account for the $52,000 to close this off the books as well. So these are our assets that are being closed off. We have just transferred the book values of all of these assets to the realization account. And in our next video, what we'll be looking at, we'll be continuing this realization account. We will also look at our bank account and our cash account. So in the next video, in our next video, what we will do, we will enter the opening balance for our bank. We would also then enter the opening balances for our partners and their capital accounts. And we will continue this question with respect to Pam, Lam, and Tien.